Welcome back. Markets are mixed this morning. Take a look at futures indicating a decline for the Dow Industrials, but a gain for the NASDAQ this morning. Tech is on fire. The Dow is down 161, and the NASDAQ right now is up 204. Driven by companies like Intel, which we're going to get to in a moment. The price of oil this morning is trading this way. Take a look at oil as President Trump has another warning for Iran, saying Iran has a matter of days to make a deal so that they can get their oil moving again before their whole infrastructure is going to explode. The price of Brent is up 2% at 107.30, and crude is up almost 2% at 97.67, with concerns growing about supply disruptions. The impact of gasoline prices, of course, here at home, also in focus.
If you need more time, does that mean Americans should anticipate spending more on gasoline for the foreseeable future?
For a little while. And you know what they get for that? You know what they get for that? Iran without a nuclear weapon that's going to try and blow up one of our cities or blow up the entire Middle East. I projected, and I'm pretty good at this, that the stock market, Howard, would drop maybe 20%, 25%. And I understood that. And I said, hey, it's a bad thing, but I have to do what's right for the country, even the world. Because you can't have them, you cannot let them have a nuclear weapon.
Meanwhile, a third U.S. aircraft carrier arriving in the Middle East to help enforce the blockade on Iranian ports, as Goldman Sachs is warning that global oil inventories could fall to record lows. Joining me now is Bolvin Wealth Management Group President Gina Bolvin. Gina, how do you read this? Do you agree with the president that, sure, we are seeing a spike in the price of oil and gas, but it's temporary, and in the bigger picture here, it's about getting rid of a nuclear terrorist? Your thoughts?
Hey, good morning, Maria. Thanks for having me. You know, the market and even the Fed is really looking through the higher price of oil. And so far, the higher price of gas at the pump hasn't slowed the consumer yet. The one big beautiful bill stimulus hasn't even kicked in yet. And consumers are getting back tax refunds that are at record levels, and they're even higher than estimated, which is helping consumer spending. Yeah. That being said, we have lowered our GDP estimate, you know, a little bit, but the odds of a recession are very small. Gas prices would have to, the price of oil would have to hit 175 and stay there through 2027 in order for the U.S. to go into a recession. We are looking for guidance in earnings next week, this week, and we're looking to see if companies and corporate America is putting any spending or business plans on hold because of the conflict.
Yeah, that's certainly something we're watching as well. But I agree that markets have looked through this. Look at these numbers. The Dow Industrials up 9% since the end of March. The NASDAQ is up 16.6%. since the end of March, and the S&P 500 higher by 11 2/3% since March 30th. Would you be buying stocks here after this big run-up?
I think this runaway rally does have legs. I don't think it's going to continue at this pace, Maria, but we've seen some strong technical progress, and mostly that the advanced decline line is at an all-time high. That means the number of stocks reaching their all-time highs is greater than the decliners. And I think what's really interesting about that is even though the market has reached all-time highs, the Mag 7, none of the Mag 7 stocks are at their all-time highs. To me, that means there's some room to run, and we're looking to earnings next Wednesday when 4 of the Mag 7 report, and I think it'll be a good earnings season.
And what a backdrop when you look at Intel this morning going into those earnings. Intel is soaring right now, up 28%. It had a big beat on the quarterly numbers and a strong outlook, revenue topping expectations and showing signs of a turnaround. And it's about growth in its data center business. Remember, the government took 10% of this company, so they're making money on this, that's for sure. The stock up 28%, and the company is talking about AI demand helping to fuel the optimism. CPUs are now back in the AI story, not just GPUs. The chip maker's still losing money, though. It reported a net loss, but of of course, it's good guidance, second quarter revenue forecast above expectations. Also talked about lots of new partnerships, deals with AI in the AI ecosystem, with deals with Tesla, NVIDIA, and others. So what's your sense of those earnings next week, then? Let's get into it. Amazon, Alphabet, Microsoft, and Meta, all reporting on Wednesday, Gina. Investors are so focused on the AI-driven profit growth, watching whether this massive spending on data centers and infrastructure is in fact paying off. Your thoughts?
Well, let's go back to Intel, Maria. It certainly lived up to the hype, and it's up 71. It's up 71% year to date. But why? Because Intel was going to retire chips they thought nobody wanted, and the demand is so strong for chips that they're actually selling them. So that's why the guidance was so strong. And chips are the new oil, right? So semiconductor chips are a leading economic indicator, and it points to the economic strength, just like oil in the industrial age was a symbol of economic strength. So we expect, unlike the last two quarters where good earnings weren't rewarded, we think this year the earnings will be rewarded when we look at these hyperscalers, and we are expecting good things. So technology is driving 80% of the earnings growth for the S&P 500, and when we saw in March a big correction in these tech stocks, we overweighted technology, and we would continue to do so.
Yeah, and all in the backdrop, you've got the U.S., the administration pushing for domestic chip production, of course, after taking that 10% stake in Intel. It's a great point on chips. Meta and Microsoft, meanwhile, with all the money they're spending, are moving to trim workforces. Both companies are ramping up AI spending. Meta reportedly planning to cut 10% of its staff. That's 8,000 jobs, while also freezing thousands of open roles. Microsoft offering voluntary buyouts to around 7% of its U.S. workforce. The one-time retirement program will be open to employees at the senior director level and below, whose years of employment and age add up to 70 or more. We spoke with the president of Meta and the president of Microsoft this week. Watch this. People are worried that AI is going to replace their jobs. You've got lots of plans and you've got small business opportunities, but how do you resize the companies when you're spending all that money, $600 billion, to, on compute capacity, when perhaps there's probably low-hanging fruit to actually resize the business and do job cuts the way others are?
I remain optimistic that there are going to be new roles, that more small businesses are going to be created. We're seeing numbers today that a lot of people who may not have thought about starting a business or becoming an entrepreneur are taking things a little bit in their own hands and, in fact, using AI to build these small businesses. And so I do think there's worry, but I think we have to be a little more proactive, Maria, about talking about the opportunity as well and making sure that people are AI literate.
This fiscal year, this 12-month period alone, we'll spend more than $140 billion, and we'll have earnings next week, and we'll update that. I think the main thing to know is we have more demand than supply. When you look at the economic impact of this, what we're contributing in terms of jobs, but more importantly, what we're contributing in terms of capabilities for every part of the economy, this is critical.
Gina, one thing that gets me is every time any of these companies report that they're going to cut jobs, the stock goes higher. Right? You saw it with Block. You saw it with Oracle. Now we see, we get the confirmation on Meta and Microsoft. Your thoughts?
Well, profit protection, right? I mean, I think it's interesting that they make this announcement right before earnings next Wednesday. And I think what's interesting is in terms of jobs, in 1940, 40% of jobs don't exist today that were around in 1940s, and we haven't seen these types of layoffs, these big headline layoffs, but the job market is still stable enough.
All right, Gina, great to talk with you. Always appreciate it. Thank you. Gina Bolvin joining us this morning on markets and the economy. Stay with us. We'll be right back.